You made a decision today that you were absolutely certain about. You felt confident, you felt informed, and you lost money anyway. That is not bad luck. That is not a broken system. That is your brain working exactly the way it was designed to work. And the design is not built for the stock market. Here is the uncomfortable truth. The human brain is approximately 300,000 years old. The stock market has existed for roughly 400 years. Your brain has had no time to adapt. Every instinct you rely on when you invest, every gut feeling, every confident snap judgment was forged in an environment that has nothing to do with tickers, earnings reports, or compound interest. It was forged on the savannah, in caves, in a world where the wrong decision meant you were eaten. And here is the problem. That ancient brain is still running the show. In 1979, a psychologist named Daniel Kahneman and his colleague Amos Tversky published a paper that would eventually win a Nobel Prize. It was called Prospect Theory. What they discovered was simple, devastating, and almost impossible to overcome. Human beings do not evaluate gains and losses equally. Losing money hurts roughly twice as much as gaining the same amount of money feels good. Read that again. Losing $100 causes you approximately twice the emotional pain as winning $100 causes you joy. That asymmetry is not a personality flaw. It is baked into your neurology. Why does this matter for investing? Because it means you are not playing the same game the market is playing. The market does not care about your pain. It moves, it corrects, it crashes and recovers. But your brain, wired for loss aversion, will make you sell at exactly the wrong moment to stop the pain. It will make you hold a losing position for far too long because selling means admitting the loss is real. It will make you avoid perfectly rational risks because the potential downside feels catastrophically larger than the upside. You were not built to hold through a 30% drawdown. You were built to run. There is a second force working against you. It is called the Availability Heuristic, and it was documented extensively by Kahneman and Tversky as well. Your brain judges probability not by actual data, but by how easily an example comes to mind. If you recently watched a stock crash on the news, your brain will massively overestimate the probability that the next stock you look at will also crash. If someone in your office made a fortune on a single trade, your brain will overestimate the odds that you can do the same. You are not calculating. You are pattern matching from memory. And memory is not a spreadsheet. Memory is a highlight reel, edited for emotional impact. This is why markets bubble. This is why markets crash. Millions of human brains, all running the same cognitive shortcuts, all feeding each other the same distorted signal, all convinced they are being rational. Think about what happens when a stock you own drops 15% in a single day. What does your body do? Your heart rate increases, cortisol floods your bloodstream, your hands may shake slightly, your attention narrows. This is the same physiological state your ancestors entered when a predator appeared on the horizon. Your body is preparing you to fight or flee. Neither of those options is useful when you are staring at a brokerage app. A researcher named Shlomo Benartzi, working alongside Richard Thaler at the University of Chicago, coined the term myopic loss aversion to describe what happens next. Investors who check their portfolios frequently, who experience that cortisol spike over and over again, make dramatically worse long-term decisions than investors who check their portfolios rarely. The more often you look, the more losses you see in the short term, and the more your ancient brain pushes you to act. Action feels like survival. Staying still feels like being frozen in front of the predator. But in investing, staying still is almost always the correct move. And your brain will fight you on that every single time. There is a third mechanism. It is called Overconfidence Bias, and it is perhaps the most dangerous of all. Studies conducted by Barber and Terence Odean at the University of California analyzed the trading records of tens of thousands of individual investors over years. What they found was striking. The more frequently people traded, the worse their returns. And men traded more frequently than women. And men had worse returns than women. Not because men are less intelligent, but because men, on average, expressed higher confidence in their ability to predict market movements. That confidence led to more trades. More trades meant more friction, more fees, More missed opportunities to let compounding do its quiet, invisible work. Confidence feels like competence. It is not the same thing. Here is where it gets truly strange. Your brain does not just make poor decisions under stress. It makes poor decisions when things are going well too. When your portfolio is up, when you are on a streak, your brain begins to attribute the gains to your own skill rather than to market conditions. This is called the self-attribution bias. You take credit for the wins and assign blame for the losses to external forces. The market was manipulated. The economy changed. You had bad information. But your wins? Those were you. That was your insight, your timing, your edge. This creates a feedback loop. You feel skilled. You take larger positions. You concentrate your bets. You stop diversifying because diversification feels like admitting you are not sure. And you are sure. You are certain. Right up until the moment you are not. None of this is your fault. That is the important thing to understand here. You did not choose these biases. You inherited them. They were survival tools, extraordinarily effective survival tools for an environment that no longer exists. The problem is that nobody tells you this when you open a brokerage account. Nobody hands you a disclaimer that says, "Warning, your brain will attempt to protect you in ways that are actively harmful to your financial future." So what do you do with this information? The answer, frustratingly, is not to try to outthink your brain. You cannot. Research has shown that even when people are explicitly told about cognitive biases, they still exhibit them. Knowing about loss aversion does not stop you from feeling the pain of a loss. Knowing about overconfidence does not stop the confidence from arriving. What you can do is design systems that work around your brain rather than through it. Automate your contributions so you are not making a conscious decision every month. Set rules in advance about when you will sell, so that future you is not making an emotional call in the middle of a downturn. Diversify not because you lack conviction, but because you understand that your conviction is partially a product of the same brain that was never designed for this environment. Check your portfolio less. Not because ignorance is a strategy, but because frequency breeds reaction, and reaction breeds loss. The most successful investors in history are not the ones who felt the least fear. They are the ones who built systems that accounted for the fear. Warren Buffett did not build Berkshire Hathaway by trusting his gut. He built rules. He built filters. He built a framework designed to protect him from the worst of what his own mind would try to do to him. Your brain is not your enemy. It is an extraordinary instrument, refined over hundreds of thousands of years, built for a world that required pattern recognition, social bonding, risk avoidance, and rapid response. It is simply not the right tool for evaluating a discounted cash flow model under uncertainty. The market does not reward the fastest brain. It does not reward the most confident brain. It rewards the most disciplined one. And discipline, by definition, is what you do when your brain is telling you to do something else. You made a decision today that you were absolutely certain about. You felt confident, you felt informed, and now you understand why that certainty, that confidence, that feeling of being informed was never a guarantee of anything at all. It was just your ancient brain, doing what ancient brains do, in a world it was never built to understand.